Today we're diving into something big, a fundamental shift in an asset that, well, a lot of us thought we understood. We're talking about Bitcoin. Its entire rulebook has just been torn up and rewritten, and honestly, the old ways of looking at it just might not cut it anymore.
And that really is the million-dollar question, isn't it? When the entire structure of a market gets rewired almost overnight, how in the world do you build a forecast for what's next? Okay, let's get into it.
So, before we can look forward, we really have to understand where we've been. For more than a decade, the Bitcoin market had this predictable rhythm. It was a story told in 4-year chapters.
And you know, each of these cycles was basically anchored to Bitcoin's own internal clockwork, these halving events that slash the new supply. This created a really powerful repeating pattern. You had this predictable supply shock hitting waves of retail speculation, all happening in a market that was pretty much its own little island, separate from traditional finance.
And then January 2024 happened, and everything changed. The approval of spot Bitcoin ETFs here in the US wasn't just another financial product. No, this was like building a massive, multi-lane superhighway connecting the huge oceans of traditional capital directly to the Bitcoin ecosystem.
I mean, just look at the contrast on this slide. It's a night and day difference. We went from a market driven by individual investors, retail, to one that's now being shaped by huge institutions and this incredibly powerful, persistent new demand. And that regulatory fog that kept the big money sitting on the sidelines, poof, it's gone.
The source material we're looking at today from Enigma in Economics just nails it. It says this wasn't just some small step forward. It was a graduation. It was Bitcoin being formally welcomed to the main stage as a real institutional-grade macro asset.
So, if the old maps that were based on those halving cycles are kind of obsolete now, we need a new one, right? We need a totally new framework to navigate this new world, one that actually takes into account all these powerful new forces at play.
So here's our new map. It's built on 3 core pillars of analysis. First up, we've got the global macroeconomic environment, the big picture. Second, what the blockchain's own data is telling us. That's on-chain intelligence. And third, the new market and flow dynamics, which, as we've said, are now supercharged by all this institutional money.
Let's start with that first pillar, the big picture financial climate. The research here suggests that the global economic weather system is really starting to brew up a powerful tailwind for an asset like Bitcoin.
Okay, so what you're seeing here is a key forecast for a dovish pivot from the U.S. Federal Reserve. Basically, as interest rates are expected to come down, getting a good return on safe stuff like bonds gets harder. That forces big money investors to hunt for returns somewhere else, making a scarce asset like Bitcoin that doesn't pay a yield look way more attractive. And a weaker dollar on top of that just adds fuel to the fire.
All right, let's move on to Pillar 2. This is where the story gets really, really interesting, because we can look right at the blockchain and see what's happening under the hood. And what the data is screaming right now is that there's a supply crisis of historic proportions building up.
Just look at this number. To really get a sense of the scale of this new demand, think about this. On the busiest days, these new ETFs were buying up more than 500 times the amount of new Bitcoin being created. That isn't a small gap. That's a fire hose of demand being pointed at a garden hose of new supply. And this graph shows that collision happening in real time. That green line going up, that's illiquid supply, which just means more and more Bitcoin is being locked away by long-term holders who have zero plans to sell. Meanwhile, that red line shows that coins are consistently leaving exchanges. The growing gap between those two lines, well, that's the visual definition of a massive supply squeeze.
Okay, so we've got a favorable macro environment and a historic supply crisis. This final pillar looks at the market's actual structure and the direct impact of all that new institutional money. Think of it like a market standing on solid bedrock, now with a rocket engine strapped to its back.
This simple chart, it tells you almost everything you need to know about this new era. For every single new Bitcoin that gets mined, the ETFs, on average, are creating demand for about 4.5 of them. That creates this relentless, built-in, upward pressure on the price. It's simple, it's powerful, and it's happening every single day.
And all that pressure is building on a really solid foundation. What this chart shows is the price holding strong, way above its 200-week moving average, which is a key long-term health indicator. So what this tells us is that this isn't some fragile, speculative bubble. It's a structurally sound uptrend, confirming that this new demand is creating real, healthy market momentum.
Okay, so now it's time for the synthesis. This is where we take these three different threads, the macro picture, the on-chain data, and the market flows, and weave them all together into one single cohesive forecast.
Now, it is crucial to understand what you're looking at here. This is not a price chart. Think of it more as a map of the analysis itself. The purple line shows the macro tailwinds getting stronger. The teal line is the market momentum building up, and that steady orange line, that's the constant, powerful supply shock. The model projects that all these forces will eventually converge at a synthesis point, which is where the market could enter its final, most aggressive phase.
And here's the math behind that map. You can see the model gives a score to each pillar. Now notice which pillars have the highest scores: on-chain and market and flow. That tells us that the most powerful drivers right now are Bitcoin-specific things, the supply crisis and all that ETF demand. When you put it all together, you get a really strong bullish final score of plus 3.4.
So, with that final score in hand, we can finally get to the projection. But look, this isn't about gazing into a crystal ball, okay? This is a probabilistic forecast. It's a data-driven look at the most likely outcomes when you combine all of these different factors.
So the model lays out three main scenarios. The bearish case, something below $100,000, would really require a U-turn in our key drivers, like if the Fed just can't cut rates. The bullish case, above $200,000, would need a perfect storm where everything goes right. But the model's highest probability outcome, the base case, well, that lies right in the middle.
And here it is. Based on that weighted synthesis of all three pillars, the model projects the Bitcoin price peak somewhere in the range of $150,000 to $200,000, with the timing most likely falling between the end of 2024 and the middle of 2025. So if you only take one thing away from all of this, let it be this. This cycle is not like the others. It is fundamentally different. It's the first of its kind, and it's being defined by a structural, institutional-led demand shock that is literally rewriting the rules in real time.
So this model, it gives us a pretty detailed, data-driven roadmap for this new paradigm. But it does leave us with one last question. As Bitcoin continues to weave itself into the global financial system and enters truly uncharted territory, are we really creating a new map, or have we just ventured off the map entirely? I guess that's a question the market itself is going to answer.